Should you invest or should you pay down debt? Today in this video, we'll answer that question with a full analysis using the custom Google Sheets calculator that I built behind me. Aside from deciding to buy or rent, the decision to pay down debt or invest is one of the most highly debated questions in personal finance and investing. Part of the reason for this is that there are many opinions on this topic out there, much of them based on that person's individual experience. This can lead to poor and sometimes even inaccurate information, making the decision much less clear. To provide an example of this, within Google, if you search pay off debt or invest calculator, you'll be directed to these free online calculators. What I found is that these calculators tend to oversimplify this decision and don't take into account the uncertainty that investing can bring. For instance, this calculator asks that you input the interest rate on your debt as well as your before tax return on your investment. In this example, we'll just use the default settings, which was 6% interest on debt and 8% return on investments. The results of this calculator says that after taxes, your debt costs you 6%, while your after-tax return on investment is 8%. Based on your current input, it appears you'd be better off investing any surplus funds while paying your minimum debt payment. You can probably already guess why this is not a particularly helpful calculator. As you probably noticed, the 6% interest on your debt is something that you know. However, this 8% return on investments is anything but a guarantee. It's quite possible your returns could vary significantly from that 8%, which the calculator doesn't take into account. Of course, if you had a crystal ball and could determine exactly what your return would be for the year, then yes, you could use a calculator like this and your decision would be much more simple. Though if you had a crystal ball like that, you could probably sell it and be set for life. For the rest of us though, we'll have to deal with the uncertainty of investing, which can make the decision to pay off debt versus investing a little less clear. Before we jump into my calculator, I want to discuss the benefits and drawbacks of both options of paying down debt versus investing your money instead. We'll also discuss specifically which cases you might want to do one over the other, and we'll back that up with results from the calculator. Regarding paying off any existing debt or loans that you have, one of the biggest positives of paying down debt is that you get a risk-free return at the interest rate of the debt that you're paying off. Any extra capital that you put towards that loan or debt reduces the principal of that loan, and you will no longer have to pay the interest on that amount that you paid off. Another benefit of paying down debt is that it reduces your personal leverage. The more debt you have, the more at risk you are for bankruptcy or running into any other issues making payments on your loans. The lower levels of debt that you have lowers your financial risk and can give you a lot more financial flexibility in the future. A drawback of paying down your debts is that it reduces your cash liquidity. What I mean by this is that once you take money and use it to pay off a loan, you no longer have access to that cash. It's going to extinguish a portion of your debt, which will help increase your cash flows in the future as you won't have to pay interest on that payment. However, for sudden and immediate cash needs, you no longer have that cash available. Instead of paying off debt, the other option you can use for your cash is to invest it. With investing, you'll get a variable rate of return, but it is something that could potentially exceed the interest paid on your debt. In this case, when your rate of return on your investments is higher than the interest on your debt, you still have to pay interest on your debt, but instead you're getting a higher rate of return, and thus you can keep the difference between what you earn on your investments and the interest you have to pay on your debt. This is, in a sense, like using a form of leverage on your investments. The downside of this is that your rate of return on investing is not guaranteed and could potentially be below the interest that you have to pay on your debt, or even worse, be a negative return or a loss. Deciding to invest money instead of paying down debt and then incurring a loss on that investment hurts twice as much, because not only did your investments lose money, but you still have to pay the extra interest on your debt. In those situations, you would have been much better off paying off your debt. One other aspect of investing is that it actually can help maintain your liquidity if you invest in a non-retirement taxable account. This is because if you really need to, you can sell assets in non-retirement accounts and convert that to cash that you could then use. Though usually the situations where you need to do that are likely the times where you least want to. Take for instance 2008 or 2009, where money invested in that period of time is worth a lot more today. So those are the benefits and drawbacks of paying down debt versus investing. And now I want to bring up specifically two cases where you likely want to prioritize paying off your debts before you start investing. The first is if you have any high interest rate debts, you need to make those a priority before you start investing. The most common culprit of this is credit card debt, which oftentimes will charge double-digit rates of interest. As we'll see with the calculator in a moment, if you have high interest debt like this, there's no way you'll be better off investing, and you should really pay down this debt as soon as you can. When it comes to your debts that have lower interest rates, it's more of a fine line, and it's not exactly as clear as to which one is necessarily better most of the time. Personally, any debts with interest rates at or above 6%, I would prioritize those over investing. If you're more risk averse, maybe that threshold is even a bit lower, but objectively speaking, 6% is a very good return, especially if it's risk-free. And that's something you can easily get by paying off any debts that are at that interest rate or higher. The other reason you may want to prioritize paying off your debts first before you invest is if you have overall high levels of debt compared to your income. The issue with deciding to invest when you have high levels of debt is that you're on thin ice. If you run into any financial troubles, which makes it difficult to make payments on those debts, then you're going to be forced to liquidate your investments at what might be an inopportune time. While you might achieve a higher rate of return on your investments than your debt in the short run, in the long run though, you're taking a lot more financial risk, which you could reduce by bringing your debt to more manageable levels. Overall, this decision is certainly a personal one, and it'll come down to the specifics of your own financial situation. With that, let's take a look at a few specific examples with my calculator to get a better sense of which scenarios you might want to consider one over the other. The reason I decided to build my own calculator was honestly because I was disappointed by the online calculators I found available and the lack of consideration for the uncertainty around investing returns. Now, given the complexity of this calculator, I'm not going to be doing a full tutorial walkthrough on how to build this like I have in the past, but a downloadable version of the calculator is available within my private group down here under Invest First Debt Payoff Calculator. If that's something that interests you, along with a lot of other investing resources, you can check it out in the link in the description below. In this blue section on the left are all the assumptions that come with this calculator, which will be used to project out your finances for the next 25 years based on how you allocate your capital. In the capital allocation assumptions, you'll have to pay a minimum debt payment, but for the remaining excess cash that you have each year, you can decide what percentage of that you're going to invest versus what percentage of it you'll use to pay down your debts. How your finances will be projected out over time and how much cash you'll have available each year will be dependent on these initial assumptions about your personal financial situation. In addition, in order to incorporate the uncertainty that can come with investing, I've added a section specifically for investment return assumptions. And in this case, you can even use investment returns that are projected or historical. For projected returns, the model assumes a baseline return in every year of whatever your set assumption is. In this case, we'll set it at 7%. And in addition to the baseline, you can add a negative return shock in 3 separate years. You can vary the amount of these negative returns as well as the timing of them to see how your portfolio and finances would respond in different market environments and conditions. Note that the investment return for each year is shown in this column E here. Now, if you'd rather use historical returns from the S&P 500, you can simply flip the switch to historical. So now you'll get the historical total return for the S&P 500 starting in the year you specify. In this case, we're starting with year 1996. Now, using historical returns, especially if you use an earlier starting year, you may run out of historical data, and in that case, the model will just use the baseline annual return that you've specified. You can also adjust the amount that's invested in the S&P 500. For instance, if you set it to 50%, the returns will be half of what you would have received if you were fully invested in the S&P 500. Then down here below, we'll project out your net worth for the next 20 years. In addition, you can get a report of your financial status in any of those first 25 projected years. When thinking about whether it's better to invest or paying off debts, the metric you'll likely want to look at is your total net worth. This is simply your total assets minus your total debts. So for our first example, let's take a look where our debts are at a 6% interest rate, which is around the level where it's not exactly clear as to whether one should pay off their debts or decide it's worth the risk to invest. In this case, we'll assume an annual income of $60,000, a tax rate of 24%, income that'll grow 3% every year, and a level off at $200,000 if we achieve that, an annual spending of $36,000 per year, and a spending growth rate matching our income growth rate of 3%. This individual will start with $20,000 of assets invested and $60,000 of debt, again at that 6% interest rate. In this scenario, let's see what would happen if they decide just to pay the minimum interest on their debt, which would be the most extreme example because they never pay off their principal value. Instead, they decide to invest 100% of their excess free cash flow. And to start off, we'll look at historical returns, 100% invested in the S&P 500 based on starting year 1996. So at the beginning of the year, they have a starting net worth of $40,000, earn $60,000 of income for the year, pay their tax, cover their annual spending, and have accrued interest on their debt, as well as earn some investment returns from their investments. At the end of the year, they'll have almost $10,000 that they can decide to allocate either to debt or to assets. As mentioned before, they will have to pay a minimum of $3,600 on their debt, so that'll be paid regardless every single year. However, based on the assumptions, the remaining amount available will be 100% invested, so the remaining $6,000 goes directly to their assets. At the end of the year, they now have roughly $30,600 in assets and still the remaining $60,000 in debt, for a net worth of minus $29,400. Going down to the graph below that tracks their assets, debt, and net worth, we can see how this scenario would have played out over the next 20 years. For comparisons to other scenarios, I'm going to look at the ending net worth at year 10. In this scenario, based on historical projections, we're looking at a net worth of roughly $78,000. This was achieved by investing all excess capital beyond the minimum debt payments. Now, what happens instead if we decide to allocate all excess capital to paying down debts? As you can see from these projections, the amount of debt declines to 0 by the end of year 8. This means with those extra payments, this person will be debt-free within 8 years. Let's see the impact on their net worth over time. In this case, their net worth at the end of year 10 was just a little under $73,000, or about $5,000 less compared to our fully invested scenario. Now, on one hand, this might seem like strong evidence that it's better to invest even if you have 6% debt, as you'll end up with a higher net worth in the end. However, do keep in mind that this was just one potential projection of returns, and that returns could definitely be different in the future. Additionally, the difference in net worth at the end of year 10 of just $5,000 might not make a significant difference to those individuals, especially if they consider that even with $5,000 less, they'll be completely debt-free. Let's go back to our 100% invested scenario and try maybe a different set of investment returns. In this case, let's try out projected returns, which are effectively a very stable 7% return, except we do have a negative shock in year 5, which is a negative 15% return. After that, though, the returns go back to our stable 7%. How did we fare in this case? Surprisingly, we actually did not so great. In this case, fully investing all excess cash flows actually left us with a lower net worth compared to deciding to pay off debt. In fact, the difference is rather significant, as this $62,000 is more than $10,000 less than we would have had by just paying off our debts. The lesson here is that years with negative investment returns have a stronger negative impact on those with higher levels of debt. This is because in those years, not only do you incur a loss from investments, but you still have to pay the interest on your debt. Based on these return scenarios, it looks like paying off your debt is the way to go. So for those of you in the private group with access to this calculator, you can explore different scenarios, both historical with different starting years and different percentages within the S&P, as well as different projected returns with years of negative shocks, to explore under what circumstances your personal financial situation might be affected by the decision to invest versus paying down debt. I would highly recommend taking a look at least a couple negative scenarios to see how the decision would be impacted in each case. The reason for this is that if markets are good, you're not going to run into financial troubles either way. If you decide to pay off your debts in that case, well, you may miss out on some of those high investment gains, but you will become debt-free much sooner. And in good times, if you invest, your returns will outpace that of your interest rate, and you'll likely end up ahead net worth-wise in the end. However, the important aspect of this decision really comes down to those negative investment return scenarios, where it's much more evident of the impact that a negative investment return can have on your net worth over time, especially if you're carrying high levels of debt. So that first example was with debts at the 6% interest rate, which is roughly at that threshold where the decision isn't exactly clear-cut one way or the other. However, now I want to take an example of a case where you should definitely pay down your debts first before you invest, and the impact that it can have on your net worth. In this case, we're keeping all the assumptions the same, except for your starting debt is now lower at $25,000, but it's a high interest rate of 20%. This would, for example, be something like credit card debt that generally charges much higher rates of interest. In addition, with this, the minimum debt payment is now higher at $5,000. Let's take a look first at our projected scenario with 7% returns, except for that year 5 minus 15% return. This first case will look at investing 100% of our excess cash. So at the end of year 10, we're left with a net worth that's roughly $80,000. This is from just making the bare minimum interest payments, so our total debt still remains at $25,000, while our assets have now increased to roughly $105,000. Now let's see what happens if we do the right move and decide to pay down these high interest debts as quickly as possible. Now we'll be diverting all excess cash flow to paying down that debt. In this case, that individual will be completely debt-free by the end of year 4. As you can see from the net worth at the end of year 10, which is now $114,000 instead of roughly $80,000, this individual saw a net worth increase of $34,000 by making the smart financial move and paying off those high interest debts as quickly as possible. Overall, I hope this video gave you a better understanding of the factors to consider when deciding to invest versus pay off your debts, as well as how to incorporate some of the uncertainty that investing brings within that decision-making process. At the end of the day, if you have debts with high levels of interest or just have a general high level of debt compared to your income, you're going to want to prioritize paying down your debt first. With debts at lower interest rates, the decision isn't quite as clear-cut and can vary greatly depending on your personal circumstances. However, do keep in mind the impact of negative investment returns when you have debt, and if you believe there's elevated risk of negative investment returns in the future, then you might want to consider allocating more of your excess capital to paying down any outstanding debts. At the end of the day, it's a personal decision and it's going to come down to your personal circumstances. However, my goal is to make you as informed as possible and provide valuable information to help you make these decisions. If you have any questions on the calculator or any topics discussed in the video, feel free to leave me a comment down below and I'll do my best to get back to you. If you're new to the channel, my name's Michael J, and this is the Value Investing channel. Feel free to subscribe for more educational content like this in the future. Until next time, thank you so much for watching, and I will see you in the next video.